And I thought, oh, I know better than this. If you're looking to buy a house, you want to get an auto loan, or perhaps you're looking to rent a building, maybe it's an apartment, or go for a line of credit for a business, or any of those apply, you're going to need to have good credit. And how do you know if you have good credit? Well, it's pretty easy. You can go pull your credit at basically any app or any software that supplies credit scores. But how do you build your credit? How do you improve it? Those are the things that we're going to take a look at today. Understanding the 5 C's. Fundamentally, there are 5 different items that are going to help you understand and build your credit. And understanding them better is going to help you to have the knowledge to move forward with knowledge and making better decisions. The first thing we're going to take a look at is your credit history, your capacity to pay, your collateral, your capital, and then finally the 5th C are the conditions. So the first thing, your credit history. The bank takes a look at your credit history. They take a look at how many lines you have, or how many credit cards, how many loans, how many basically items that show up on your credit report. They take a look at how often do you pay those on time? How often are they not paid on time? How often are they delinquent? That's pretty important to the bank, is your credit history. Then we take a look at your capacity. That's also known as your debt to income ratio, the DTI ratio. The debt to income ratio actually takes a look at the amount of money on a monthly basis. So not how much money you make a year, but how much money you make each month. And they take a look at how much money you make and how much money you spend each month. And the items that they're looking for are the items that really show up on your credit report. So an auto loan would show up on your credit report, a home loan would show up on your credit report. Other items such as your gym membership, it's not going to show up on your credit report. So basically any items that show up on your credit report is what we're interested to take a look at in considering your debt to income ratio. So basically picture this. If you spent every single dollar that you made every month, then you have no money at the end of the month. And so when banks take a look at this, they want to make sure that you are not actually spending all the money that you make every month, but in fact only spending less than 50%. Let me see if I can kind of reword that for you. So if you make $100 every month and you spend $100, you're at 100%. You're actually really high risk to the bank or to somebody who's going to lend you money, because you're spending all of your money at 100%. The closer you get on the other side to 0, basically the lower risk you are. So if you're at 30% or 40%, that's an okay number. But once you get to 50%, debt to income ratio, or how much money you make each month to how much money you spend, then you become kind of a little bit more risky. And so just keep in mind, the lower you are, the closer you are to 0, the better chances you are to having a lower debt to income ratio. Now we're going to jump into the collateral. When the bank lends you money, they want to see what collateral you have. What physical property do you have that you could put up as collateral? Is it the automobile? Is it a house? Is it a motorcycle? Is it a boat? What are you purchasing and what do you have for collateral? That's really important. Now let's jump down to the 4th C, that's capital. Let's say that you no longer have your monthly income and you're not able to make your bills. You're not able to pay back the loan, the guy that gave you the money. What is it that's going to help you to pay your bills? Maybe it's a retirement account you can dip into. Maybe it's a savings. Maybe there are other funds of money that you can go into, but the bank is really interested to see what you have for capital and how you're going to pay them back. And inevitably, they think that if you have extra money sitting aside in a savings account, that you're still going to be able to make that monthly commitment to the bank. And so that capital is really important to show when you're applying for a loan. The 5th C is conditions. The conditions, the bank wants to know where you're using their money. Now, it's not always true. They don't always want to know where you're using the money, But if you're going to use the money to refinance or something of that nature, then they're very interested to lend you money. But if you're going to go out and spend it and basically max out your credit card or max out the loan, they might be less likely to actually give you that loan in the first place. So be aware of how you're going to frame it for the bank and how you're going to put that together. Of course, you never want to lie. You always want to be honest, but maybe you haven't thought about how you're going to be spending the money today. So there you have it. Those are the 5 C's. That's the credit history, the capacity, which is the debt to income ratio, collateral, capital, and conditions. Now that you know that those 5 things are super important to building your credit, you're going to be more empowered and you're going to have the knowledge to be able to improve your credit. Now, I'm kind of going to jump off script here and just freeform it. I once upon a time went to IKEA and I signed up for a new credit card at IKEA, and I think they gave me a $13,000 limit. And I thought, this is great, no problem. It was actually during checkout. They said, hey, we'll give you a certain discount. And so at that point, I signed up for the credit card and I put everything on the credit card. I put the whole entire purchase there. Keep in mind, that credit card was actually maxed out. So when the bank takes a look at that one line of credit, they say, wow, that one credit card was maxed out. Now, it's okay to do for a short term, but if you keep that there for an extended period of time, that actually is going to bring your credit score down, and it's going to reflect negatively on your credit score. And I confirmed that this past week when I re-upped a business line of credit with my business banker. I was joking around with her and we had some good conversations, and she was very open with me. And she said, we like to see that you're using your business line of credit, but we don't want to see it maxed out. And if it is maxed out, we don't want to see it maxed out for an extended period of time. And that goes with any sort of revolving line of credit or any sort of credit card that you have, including, a Home Depot credit card or Lowe's credit card, IKEA furniture, that's the same thing. So really try to pay off your credit card and keep that to basically 50% of the line of credit or less. So that's really important to helping with your credit score. Now, when I did have that IKEA credit card opened, I noticed my credit score actually dropped quite a bit. And I thought, I know better than this. I should have known. So I was a little bummed out of myself. But the point is, I was able to repair my credit. It actually shot down quite substantially. And I was able to repair my credit over the next 3 months. Now, I'm in a good position where I was able to go in and pay off that credit card without having any issues. But if at the same time, if you're not, just try not to charge more than 50% on any line of credit or credit card that you have. And then you'll slowly watch your credit score improve from there. If you've enjoyed watching this video, like, subscribe, and even share it with a friend. I really appreciate your time today. Thank you for watching the video.